Not understanding the market cycle can cause serious damage to your financial well-being if you make the wrong moves at the wrong time. Hi, I'm Jared Kraus.
And I'm Sam Powell, and in this episode, we're discussing market cycles and helping people not get caught up in analysis paralysis to help them make those smarter buying or even selling decisions.
Yeah, we talk about how long a market cycle is in this episode, where we're at in the market cycle, and the peaks and the troughs, and when you should buy and when you shouldn't buy, or how to buy.
Yeah, it's really important to understand that there is markets within markets in Australia, and there's definitely times where it's not best to be buying, and it could be an opportunistic time to be taking some chips off that table. So having the right discussions with the right people is really important, but it really does start with just listen to this podcast, and there's a lot of value that we can share. So we do hope you enjoy.
Yeah, we also talk about not just the property cycle, but how the property cycle fits in the macro economy of other markets and what those other markets are and how you can track it and how you can use those to your ability to understand what's coming in the market cycles as well. Also understanding the economic conditions of Australia and what's happening with migration, what's happening with building in our area, and what's happening with like the either negative growth curve or the positive growth curve that we may or may not be in within Australia.
Yeah, there's the supply demand metrics that are really important. So hope you get a lot out of it. Listen on in, but just as a reminder, this is not the only way we can help you. So please jump onto our website, www.propertypals.au/resources. We have a really great free tool course. It's just how to maximize your borrowing capacity. We are seeing some really opportunistic times in this point in the market cycle. So listen on in, get that confidence, download that resource, and please reach out if you have any questions, which is hello@propertypals.au, and see you on the inside.
Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jared, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. Samuel, our first ever away from each other podcast.
Yeah, it's exciting. How's Bali?
Yeah, it's good. Feels very different being not sitting next to you. I don't know how the vibe's going to be, but I think we're going to make it work, and I think it's going to be fun.
Yeah, no, it'll be fun. But I like the setup, and that's what we're all about, right? You can live and work anywhere in the world, and you're doing it. So it's inspirational. So good on you.
Yeah, and you've got your own home studio set up now, and it's looking legit. So
yeah,
let's rock on.
Lashed out and bought all the podcasting equipment because you've left me, and yeah, it's exciting. So I'm pretty keen to get into this one and see how it all pans out. Some sort of key topics that I wanted to touch on, which is pretty relevant in any market, but I think it's going to help a lot of people understand what position and what cycle they're in with the property market, so they can actually use that to their advantage when they're going in and buying these properties.
Absolutely, I think it's pretty timely for both of us. You mentioned like text me just before this pod and like what do you think we should talk about, even though we've got a laundry list of things that we want to get through. You having some interesting times, trying to explain market conditions with clients, the market cycles within my own portfolio and when to buy, how much time do I have in a cycle before I consolidate and then reinvest. So yeah, like let's just start off about us talking about a cycle. What's a cycle? Like what's a property cycle?
Yeah, so probably all markets move in cycles. There's peaks, there's troughs. and then there's those times where you're in the middle, right? So it's like a wave. We call it market cycle wave. There's actually a famous economist, Condrati. They call it the K wave. He developed that, but have a look into it. But it helps people understand. It's human psychology. It's really cool, actually. It tracks, the market. So you start to see prices start dropping. They generally drop really fast at the start, and they start to peter out. You'll have times where people are like they're seeking for that opportunistic. So the market's dropped 10%, so they think it's a great time to buy. But it's really important to understand, you don't want to be catching a falling knife, is what we call it in the industry, because markets do, on the way up, they go up, they pull back. They need to pull back to keep going higher, and on the way down, they need to come back up to keep going lower. Does that make sense?
Yeah, yeah. So there's so many questions around cycles. Like a lot of people have been told or heard, and maybe at the backyard barbecue, or a kid's birthday party around a market cycle, and property market cycles move in like 10 years or whatnot. I guess let's bust some myths and come up with some, share some realities with people around those. So like, what are some of the common myths that you've heard getting thrown around property market cycles, and property doubles every average of 10 years, and all these sorts of things?
Yes, yes. Well, I mean, everyone's got an opinion, and it's how far back you want to track the market. I, I personally, I'm a believer that we do see multiple. There's multiple cycles in a larger cycle, so you can look at from a commodities point of view. They've got a 30 to 60 year cycle. You've got the political cycle, which is a 4 year cycle, which also affects the property cycle as well. But from where I like to look at it is, you're looking. It's a combination of everything. So property, the values, like a lot of people's uh, money is held in the value of land. So you think about it from a psychological basis. When property prices are going up, people can see the values of their assets, which is property is generally most people's largest asset that own a home. And when they go up, people feel wealthier, so they're more inclined to spend. And when prices are going up, it's a sign that the economic conditions in that nation are doing quite well. So you get this confidence boost, and then you'll start to see things. You'll get the doomsdayers coming out, and then the media shifts from a positive vibe into a cautious markets peaking, and then everyone, it's like a self-fulfilling prophecy, because if people are constantly looking at the media in that sense, like they're a private enterprise, right? So there's an agenda behind what they're selling to you in a way. Like it's all free to wear stuff. You got to start questioning yourself, well, what are they trying to achieve here? And because they have such a big impact on the Australian psyche, it does affect property prices, but in reality, that's where, that boots on the ground, doing it every single day, you see what's actually going on. And for the past few years, I've seen the media pumping the property market and then telling everyone it's going to fail. And now they're back into pumping it again. And the whole time I've seen markets rising, just in certain parts. Like, so,
Mm-hmm.
18 months ago, Sydney was, it pulled back 10% on average. And in their mind, it was like the world's ending. And they're only focusing on your Sydney and your Melbourne markets. So they're obviously your two largest markets. But it does peter out through the rest of the nation. And we say that there's markets within markets. So there's the micro cycles, like say the Gold Coast has its own cycle compared to Brisbane. But all in all, they're kind of all they're more closely linked, the Brisbane Gold Coast cycle compared to the Sydney cycle. But understanding how it all works is really important. And Sydney, because it is the largest market, as well as the Melbourne market, they tend to lead that growth cycle, or where it comes. So we're seeing now, I've been sort of talking to people about Sydney market, get into it now, and don't be afraid to pay those prices, because the market's lifting, and this is the whole point of obviously the podcast, is what I want to talk about, is this is relevant for commercial and residential properties, is if you're buying into a market that is showing signs of growth, your purchasing power is getting diminished every single day that you're not in that market. Does that make sense?
Yeah, yeah, absolutely. And it's interesting, like in just my personal property journey and watching the property market, I've noticed that when the fear mongering or the fear media is out there, and this is what the wisest investor in the world, Warren Buffett says is, it's better to buy, be fearful when others are greedy, and greedy when others are fearful. In terms of like invest when he says also invest when there's blood in the streets, sort of thing. And when the media turns to a narrative of, oh no, it's all going to be super bad, typically that's the best time to buy, because people are selling at, and this is very typical, this is not financial advice, but they're selling at a lower price, and you can pick up a really good deal at a good part of the cycle. Now, how big are cycles and how long do they run? How big is a property cycle on average?
Yeah, well, I'm a student of this, obviously, but there's uh, a teacher or mentor that I like to look into, which is Akil Patel and Phil Anderson, and they're big believers in the 18-year or 18.6-year property cycle. And I've done a bit of research into that theory, and it makes logical sense. And what they tout is that during that 18 years, you've got the 14 years of up and then 14 years of down. But in the middle of those 14 years, you'll see a 1 year down period. So it's like the market pulls up, goes up 7 years, pulls back for 1 year, and that pullback allows it to then kick on to a further high. And then you've got that peak, and then you've got a 4 year downturn. Now,
So let's just repeat that again, because I think that's so important. So you've got the overall time frame, and then let's break it down to those bits again, because I'd like to just, yeah, can you mention that again, please?
yeah, well, let's look at it from the most recent market downturn was in 2008, right? GFC, everyone knows about that one. So that the market peaked in about 2007, 2008 in Australia. So Australia, from an overall market perspective, lags your larger markets, which is your America and your UK. We're very closely linked with them.
Mm-hmm.
We're also getting more linked with, obviously, China and Japan, the Asian countries too. So
It also lags like the business sector, like stocks as well, right? In America and also in Australia, and even now lags like crypto market too.
yes,
Yeah.
yeah, I love where your head's at, and I'm a big proponent in diversification. So get into it's not just property, it's shares, it's crypto. Crypto is obviously the higher risk, but you can also find those shares that are just as high risk as crypto. It just depends on their market capitalization at that point. But
Yeah.
property, because it is such an expensive asset to acquire and sell, it's slower to move. So I look at property like a big barge, where to turn around it takes a long time. Whereas your crypto markets are more like we used to drive around in dinghies back in the day,
Mm-hmm.
little 15 horsepower, and then your stock market might be just like a nice cruising boat that can turn, but it takes a little bit longer than your dinghy kind of vibe. So
Yeah.
because for shares and for crypto, in order to sell it just takes a click of a button.
Yeah.
Whereas property, you got to get it ready, you got to find an agent, you've got to list it on the market, you've got to wait for the market to tell you, this is the price you're paying. But accept that offer, then you got to wait 30 days or whatever you need to do to settle on it, and then the money gets in your account. So it's that's why I'm a bigger proponent for property, because it's just lower risk.
You can see it coming if you understand the market cycles, which is what we're trying to share with everybody here, right? Like, so there's two sort of threads we can pull on now, is like the overall macroeconomics and how a property cycle fits in macroeconomics within the world. And then we've also got like the individual property market cycle. So maybe let's touch on the individual property market cycle and how that fits in then with the macroeconomics. So we were talking about the the timeline of a full cycle. So I'd love to hear like the timeline of the full cycle and then the timeline of the troughs and the peaks again, just so people can really comprehend this.
Yeah, yeah. Well, I'll do my best. But so the market, let's sort of run it from what's most sort of common. So you'll get that from the 18-year period. You've got the bottom of the market 2012, and that picks up. Starting to everyone's at that point. They're like, oh, the market's ending. It's just been falling for years, so they've lost hope in it. And like from that 4-year downturn, it's you just think about it from the psyche of a buyer. They're like, oh, prices are discounted in the first year. We can get in. It's 10% cheaper than what someone paid for it last year. It's a bargain. Let's do it. And then they buy it, but then the market still drops and keeps dropping. And then they like get deflated. Like, oh, the property prices, we've been duped. It's the world's ending kind of vibe.
Yeah. So that's the 4 years. That's the 4 years from 2008 to 2012, which would you call the start of a cycle?
I call that the end.
The end. Okay.
From my point of view.
So we're working
Because
backwards
that,
here.
yeah. So that was sort of like the end of the cycle. But before that, yeah, you got that mania phase, right? From sort of like there was the .com bubble where everyone was freaking out. I remember when we were there, it was like, oh, Y2K, if you remember that, like
Yeah.
jumping over from 1999 to and it was the computers, they're going to be all zeros and it's
Yeah.
going to dysfunction, and there was a bit of a period there where there was a lot of fear, and obviously 2001 was a pretty dramatic event in the world where 9/11 happened, and then but like from that it was 7 years that was of this prosperous time, right? So I'm working backwards from the 18 years down, right? So that 7 years from basically 2001 to 2007 was just crazy. Property prices went through the roof,
Mm-hmm.
and I was doing valuations back in my time, like 2012, of what valuers were putting on these properties in year 2009s, and you could see the mania, like it was still in the market in 2009, even though everyone knew that the banks were failing over in America. But we just thought because we had the commodities cycle here in Australia, we weren't really affected. But most people just didn't see it coming, right?
Yeah,
Um,
yeah, we do have a
something
pretty
like
strong economy, but at the same time, like if you look under, like we do get pretty close to some gnarly stuff happening within our economy.
yeah, but it's always this is like the cycle theory, right? Like there's always a reason not to invest or not to buy a property, but then that's the analysis paralysis. So what I've been trying to do for the last 2 years is just more understand how this system works, and it's not an exact science or art or anything like that. It's just trying to look back on history and allow that to dictate what your thought processes are, because it never repeats, but it tends to rhyme from the research that I've been doing.
Yeah.
And going back from that historical timeline, like before, like we had the late 80s, there was a recession, in our time frame. Like you think about it, like everyone talks about, oh, back in my day, interest rates were like 7.5%, and they were just gnarly, and that was the kicker into that 4-year down cycle back in the late 80s,
Mm-hmm.
and that 4 years started to end in those early 90 periods. So that's how you had that initial 7 years kicker. 6 years into the late 90s, it was performing really well. There was a lot of money coming through from your Asian markets. Like the Japanese market they were just printing money, and they were just buying everything. It was really kind of interesting to see the history there. And then we had that kicker, and then it was, oh, the world's ending again. You had that, Y2K, 2000, 2001 pullback, and then most people, they had that fear going, oh, all right, well, that was 1 year down, and then it went into another 6 to 7 year growth kicker. And this is the psyche, and we're entering into something like this in the foreseeable future over the next 5 or 6 years. But people, like with COVID, the mid-year cycle for us here was in that 2019, 2020 COVID period where
It's a bit of a hiccup.
it pulled back, and everyone thought the world was going to end, locking down, and then it boosted again. So my fear for most people coming into this next phase of the cycle is that they're going to think it's going to be a 1 year, downturn period, but it's going to end up being a multi-year downturn period, and they're going to get caught out, and they're going to be those ones that are catching that falling knife. And
Yeah.
the biggest thing is that there's still opportunities in each market to be making money. I mean, there's locations in Australia that were going up in value during that 2008 to 2012 period because the underlying fundamentals of that regional location was prosperous.
Yeah,
Does that
strong.
make sense?
Yeah, they might have different government infrastructures and stuff being built, and then even private infrastructures in terms of shopping centres that bring more people to maybe a better place to live at that time in the world. So that's really gives it's like we're not here to fear, to put out fear of like you need to really. It is worth understanding the market cycle. But like through that 4 year downturn doesn't mean like you just sit and do nothing. Like there's things that you can do. So I still want to get this whole cycle wrapped up. So we've got from going backwards from 2012 to 2008, we had that 4 year downturn. And then from basically 1999, 2000 to 2008, we had that 7 to 8 year sort of uptrend. And what happened before that, like, so you've had that little like that .com bubble thing. I remember at like 12 o'clock at midnight on the year 2000 started. It was, the world, like computers are going to take over and stuff like that. Like it was, we were pretty young, right? Like I remember that being, said from our parents and stuff. So I can't remember how old I was. It must have been 12 or something. But
We graduated. The age, man. We were
we
we were
05 we
finishing year
graduated.
seven.
Yeah. So we're in year 7. Yeah, exactly. So, then you've got that little hiccup, but before that little hiccup and the 7 year upturn to the GFC, what happened before that? Right. So you've got your 4 years and then your 8 years, obviously
So
equal
generally go like
12 years.
4 year, like from the very start, you'll get that. Say you work from the bottom, right? It goes 6 7 years up,
Yep.
1 year down, 6 7 years up, 4 years down.
Okay, cool. So you've got that before the .com millennial thing. You had 6 or 7 years of growth, little hiccup for a year, and then another 7 years of growth, and then 4 years downturn. So that's the full property cycle.
Yeah, and the what's really important, we're going to get to the back end, which is really interesting, of the current market, right?
Yeah,
So just stay
absolutely.
tuned to it. But what I'm learning about all this is that that's a decent chunk of people's time, right? Like you're getting different generations come in, and they're getting different confidence levels. Like what we're seeing now, like I'm like we're 30, we're 88 babies, 35, so going into, we haven't seen hard times, so that confidence level is quite high.
Mm-hmm.
And then like the other senior valuers I used to work with, they'd been through different cycles. They were really risk averse, in those sort of 2010 to like pretty much when I left in 2019. And I was always like, oh, why? But you start to see it, and people's confidence levels come in. The older you get, the more life experience you have, right? So you're starting to question certain things. What the issue is some of these older generations, they get burnt and they never get back in, and then they get to their 50s and 60s, and then they're rushing around trying to make it work, and they're getting caught up in all that hype in the market. Everyone's making money, and then they jump in. And it's really bad to be taking risks from a financial perspective later in your life, right?
Yeah.
It's just, you got to take those higher risks, get those higher returns. My mindset is trying to teach people to start taking low risks early in life and just make it easy for yourself.
Absolutely. And I really feel that when you're younger, you have less fear. And as you age, the fear can increase depending on who you are and the lifestyle that you live. But I know that I wouldn't do some of the things that I used to do, right, when I was younger. And I know that when I'm older, and if I have like haven't got the best financial situation, I'm going to have a bit of fear around I need to do something about it, right? And make a decision that may not be the best thing for me at that time in my age with my money. So it's very like interesting waters to navigate for somebody that is 50 to 60 and how they're going to invest and try and do it without fear and then understand the cycle as well. So
Well, the biggest thing is that the world. We've touched on this previously, and obviously, I'm a student of life too. So, go back, do your own research, look into these things that I'm talking about. Check out property share market economics. Really interesting, like how in depth they've gone back. And before Akil, there was Phil Anderson. Before Phil, there was his name, another fellow. So they've all learned, they've progressed, in that. And the thing is, in wealth, right? Once you understand the journey, you really have to have a passion about it to go in and teach people these things, because you can learn it yourself. You create your own financial abundance, and then you can just relax and enjoy life. So that's kind of like Fred. Yeah, I think his name's Fred. Anyway, check it all out. It's interesting stuff, and like you can't hide behind the data. And if they're tracking it back to for hundreds of years to see how this all works, right? And for me, it comes down to just the psychology of it all too, right? People forget, and then it happens again. You get political cycles that are mixed in with that. I mean, in Australia, we run a 4-year political cycle, so it's never in the politicians' best interest to be trying to get it re-elected if the economy has gone to crap, right?
mm-hmm.
So they try and pump it up. It's all sort of marketing and media from that sense. But we are heading into interesting times. The beautiful thing that I find in Australia is that we're really strategically positioned for this next 10, 20 years, right? Like we've got really strong relationships with UK, America, your Western societies. And then we've got really, really strong relationships with Japan and China. In India, we've got a really big immigration program coming through where we're opening the borders up to these countries that, they're jam-packed and they're looking to, go into a different lifestyle. And Australia is super attractive. And for our land mass, we can support more people. What our issue is that we don't have houses. We don't have enough development approvals going through to house all these people that we're bringing into our nation. And that's why I'm bullish for the next couple of years in property.
Yeah, let's talk about the next couple of years and what's coming up and where we're at in the cycle, right?
Before we continue today's pod, I want to ask you a few questions. What is your property investment goal? What type of properties do you want to own? How many? What size valuation property portfolio do you want to own? And how much net income do you want to be earning? Essentially, what's your magic number in passive income that you want to be earning? And do you know how to get there? And if you do you know how to get there in the least time possible with the least amount of risk?
Sam and I have been helping people invest in property and build property portfolios for years. People who are now replacing their income through property, and we want to help you do the same. Right now, for a limited time, we are offering free property coaching to our listeners. We won't be able to do this forever, of course, so head to propertypals.au/coaching. That's propertypals.au/coaching to see how we can help you achieve your investment property goals. Link will be in the description too. Obviously, the cycle, if we're going from the downturn from 2008 to 2012, we started basically, and just when I mention this and Sam and I talk about this, like just because we mention a year doesn't mean it's going to happen like clockwork on every single year. It's variant on the economy and our own human psyche and how things move. So don't hold people that, these are very rough predictions, and it could be out by 2-3 years or so, right? We just don't know, and that's why we need to understand the macroeconomics of how the share market cycles are moving in Australia, over in America, the crypto cycle moving as well, and then also see how that behaves, or the property market behaves based on those things as well. So if we're starting at, say, 2012 at the bottom-ish, and then we've got from 2012 to where we're at now, right? So we're coming up, like, we could just say that's like 11 years, almost a decade. And we've had a little hiccup, I guess, through the pandemic thing, right? So basically, from the pandemic thing, we've kind of got like another 6 or 7-ish years or more, give or take, which brings us from like 2020-ish to 3 years now. Like, am I correct in my calculation saying we've got another few years of like, let's see what happens in the next 3 to 4 years with this? Like, is this the last little uptick? And then what do we
Yeah, so
do?
then what do we do? Yeah, this is obviously all general, just having a bit of a
Absolutely
discussion, but
general. Yeah.
it is fascinating. This is kind of what my mind is more interested in at the moment. Obviously, done a lot with everything else, but yeah, when you're dealing with people's money, I want to make sure that I'm doing the best thing by them and giving them, my honest opinion.
Mhm.
And if you look back in the history, it's you have to expect markets to pull back, and that's just the realities of it. If going in answering your question now is, look, the peak that they're talking about is 2027,
Mhm.
and that's over in America. Generally, Australia lags America by about 12 months. So this is all the things that I'm learning, which is really interesting because that's pretty much in line with actually what happened. The GFC, so that 08 was the peak there. 12 months later, we started seeing the pain here. And then what actually happens is and this is why I'm really sort of energized about it, is we're entering into the last phase of this cycle, right? And you read books, and because I'm in the market every single day, I'm actually seeing these things unfold in real time, and it's uncanny how strong a relationship there is to
Mhm.
what they're talking about. And this is the situation I see. So we're in 2023, going to be going into 2024 pretty soon. So we've still got those probably 3, maybe 4 years. But what I'm actually seeing is our migration numbers are increasing. Last year we took 450 plus thousand people into Australia. We're bringing in another 315,000 is earmarked for the next 12 months.
Wow.
Our building approvals are not in line with the number of people that are coming through. I mean, we're already seeing like rentals have gone up, over 10% in Australia in the last 12 months. So that's a key indication that people are struggling to find places to live. And then if you go, I mean, you go on current affair, Today Tonight, all that media, like you'll see these stories every now and then, people struggling to find places to rent. And then the renters feeling like it's an unfair go, and then governments changing policies for landlords and making it difficult for people to invest, even though that's the best thing for them.
Mm.
Uh, and then you're getting these big developers, which is really interesting. How in tied these people with a lot of money and their connections in government systems. The build to rent scheme is really booming, and it's coming out. And these developers they're just cleaning up, right? They're building a whole building and renting the whole thing out. Like they're taking that hit on the way in,
Mm-hmm.
but then it's just heaving cash, and people are just
Yeah.
running over themselves to try and get into a rental, and prices are going up, and they're going to continue to go up because we have a supply issue in Australia, and we've got a population that's increasing and increasing at a rate that's already in a stressed environment for supply. That's why prices are starting to increase all around Australia again. And then this is this mania phase, right, where you're getting these two key elements of high demand and
Low
lowering
supply.
supply.
Yeah. It's
And
it's
that's why I'm
it's wild that people are thinking like after the pandemic thing, like it went pretty crazy, like the property market in most of the world. Like, how can it continue to go up? Well, if you understand what Sam's just said, like that's exactly how. And there's like that's where we're at in the market cycle. Is like it could be a 3 to 5 year period of like, if you look at like any chart of any growth in any sort of sector, crypto, S&P 500s, 200s, index funds and stuff like that, it has this one little peak, this one little like crazy uptrend until it gets to like the top, and then it starts to slowly then does that. Sometimes it's a hectic decline, but we're talking about like that's where we're at in this 3 to 5 year period of like it could be, and this is very general for like all sort of the whole property market, not just markets within markets, but like as very general. We've got this next sort of 3 to 5 years of like crazy, like sort of steeper growth curve than typically ever in that whole 18-year cycle before it gets to that 20 and 20 mid 26 to like maybe even 28. Who knows where it could be. But if you understand how to look at these other economies, then you will start to see it coming. Wink wink, nudge nudge, just check out what America does, because they're usually first, right?
Yeah, that's the beautiful thing of it, and like yeah, obviously that's where the skill set of also people say, when's the best time to invest? It's like when you have the financial capacity to do so, but go in with your eyes wide open.
Mhm.
People will always be trying to buy a property for you, but you've got to understand, by amplifying your opportunity cost in this market, you're going to be buying into a location that has better growth potential, but also you're looking at locations that will be less affected by those major downturns. And generally your major CBDs, they do, that's where a lot of the majority of people are located, and the psyche of those buyers tend to get affected quite dramatically. Like,
Mhm.
say during COVID, Sydney pulled back that 10%, right?
Mhm.
Whereas places in southeast Queensland went up 20%, which is just fascinating. But general public don't know these things because they don't have the time to track it every single day like I do.
Yeah,
Um,
yeah. I think it's interesting that people are probably thinking now, like, all right, like if they've got some money, or maybe they don't have some money, right? But they've got one properties or two properties or maybe four or five properties, and then like, what do I do from a portfolio's perspective? And there's so many different scenarios that you can do, right? And you and I have talked about this a little bit, Stan, with like in my own personal thing of like, what do I buy next? Why? What type of asset? How? And like you said, you could buy, if you are looking to purchase, buy something that can get that capital growth in these next 3 to 5 years or 3 to 4 years or whatever it looks like. And is also not going to be too susceptible to a market downturn, or like that 3 to 5 or whatever year growth in this last little part of the upside of the cycle. It'll offset that. It's not going to be too dramatic of a hit. And then depending on what other properties people may have, is like we typically don't tell people to sell properties, but we've got to look at opportunity costs as well. So if you've got four properties and you bought a couple of the last part of the cycle, you may not want to sell them because you might lose money on their entry and exit costs. But if you've got other properties that like aren't in a high growth location, you could maybe take some money off the table for a little bit and then go and find those locations that are growing in that downturn where everybody else is like, oh no, like everything's gone to crap. And you could wait 2 years out of that like downturn of the cycle and find something, right? So there's so many scenarios that people can play out. What would you say to that, Sam?
so just reach out to us, hello at propertypals.au, and just have a chat, book a call, and we can discuss it further, because it might be, depends on where the property is, right? Like, it might be an opportunistic time to sell,
Mm.
um, and as you say, take some tips off the table. During this cycle too, and this is what I'm seeing, like, rents are going to keep going up too. So whilst there might be values in properties won't be as, they might be pulling back, but the rental and the income you're getting out of these things is still going to be really strong, and that's going to help you hold it. Like, ideally, holding it through, like, 4 years is not a long time. The market just keeps going. You're buying these things for that 10-year plus period because you're getting multiple cycles. So
Mm-hmm.
any property investor should be seeing down periods and growth periods. And if you're trying to time the market, you might get too caught out. But during those tougher times, like those 4-year downturns, access to credit is going to be an issue too. So if you do take those chips off the table, you can get that real peak, sell near the top, and then you cash yourself up, and then you can either, go into shares, you can, or other alternative assets where they're more liquid, or you just put it in cash, offset your debt, you're paying less interest, you're getting more income because your rents are going up, and then you can sit there and go, all right, cool. Well, the market's been dropping for 2 or 3 years now. Let's go shopping. Let's get some bargains.
Yeah. Yeah.
But yeah, the world never ends. Like I'm only only me, but you just got to think about it. We've been around here for hundreds of thousands of years. The world keeps spinning. It's just a psychology of markets, and we're so intertwined with it that it affects our decision making. But you just focus on your health, good relationships, and just invest in things that aren't going to stress you out financially, and then just enjoy the ride. Like, it's a beautiful place. The world is a beautiful place.
Absolutely. And it's just the education, like listening to this podcast, it's really equips you like with so much knowledge to not make rash decisions. And that can help you just, put your money to work in the right way that's less stressful for you. So you can just like move through the cycle. Like this, I think a lot of people do really fret about like having to be too perfect in their investing and like buy at the bottom and sell at the top. And there's so much work that goes into trying to understand where that top is and when that bottom is. And even like the best day traders still like get it wrong, and they've been doing it for like decades. So it's, why, like if you just invest for the long term, and it's less stress, and know that you're going to have, you can ride those bumps.
Yeah, I used to day trade currencies, and the whole theory was you'd get, as long as you're getting 60% right and 40% wrong, you're doing really well.
Yeah.
So the motions of that, it was just not for me. That's why I got out of it. I like the long term games of just keeping it simple. You're not checking your phone every few hours to see that you made a few grand. It's just property is just a more beautiful vehicle for my personality type. Another thing I'd say is just with the owner occupiers too. Like, a lot of people, they've done all the hard work. They save their money and say they're sitting there going, "Oh, the market's going to crash," and once again, reach out. Let's have a conversation and understand where we are in the cycle to see, whether that might be right or might be wrong in your typical the suburbs that you're buying into in Australia. But it might be a different financial position. I put it this way: you're earning good income. You've got that capacity to buy that $1.5 million home, your dream home for your family, and your income's quite secure. But if you don't do that now, and then the market does pull back, and then there's different lending restrictions, then that dream home may not be available to you, or one of you, things are always changed is kind of my point. And it's just making those more educated decisions, but go in with your eyes wide open. If you're expecting a slow period for the next 2 to 3 years, then don't over leverage yourself. And the importance is just having conversations with people that can shed a bit more light on it, rather than you going around in your hamster wheel in your head. You know what I mean?
Yeah, it's so situational. Like, we just talk about one thing, which is like the cycle, the property cycle, but that's a totally different thing compared to where people are at financially in their own lives. And some people may not be perfectly in sync with the cycle to buy at the low and sell at the top, but there's still moves that you can make. So reach out, guys. Hello at propertypowers.au. We're happy to chat to you about it. We're not going to try and tell you to sell or buy or do anything that you don't feel comfortable doing. And we're not trying to make you make moves. So, because we don't really, aren't trying to find a benefit for that. We just want you to do the best. And when you do the best, everybody else will be, winning as well. So in your life, that is.
Yeah, it all comes back. But the better you do for somebody else, then obviously it's hard to find people that you like and trust in this world, especially in property. It's called sharks. But conversation can potentially make you some really good decisions. And obviously we've got some interesting resources on the website, so check that out. But I wanted to touch base onto where we are now in the cycle and what I'm seeing, and to try and help people. So this is more sort of timely.
Yeah.
When this podcast gets released in a few weeks.
Yeah. Excellent, excellent.
But yeah, what I'm seeing at the moment is, the reason why we covered all this microcycle stuff, because we're in this boom period. We're hitting this kicker. You're going to see media coming out really soon saying, property market's booming, and by then, it's not too late. It's never too late, but you're in a competitive market already. So what I mean by that is you're going to be looking at comparable sales to justify your opinion in commercial and residential. You're looking at comparables and saying, well, I wouldn't pay $1 million for that. I only pay 950,000, and it's like, okay, well, that's fine. However, there's about 10 other people that are willing to pay that $1 million. So once that property gets purchased for $1 million, that's now your new benchmark. And the other 9 people that have missed out on that $1 million purchase because they weren't willing to go to that level are now still hunting for property. And we're on a supply shortage. We've got an increasing demand. Your purchasing power is getting diminished every single week that you're not into that market. So you've got to come to terms with, if you do put an extra $10,000 or $20,000 on the table, yes, it might feel like you're paying that future value, but the market's increasing greater than that on $1 million purchase every 3 months, right? So if you find an asset that ticks all your boxes that you're really excited about, work with someone who knows how to negotiate really well and can give you that live feedback. You'll see that demand coming through. And the true definition of market value is a local agent in an open market, willing buyer, willing seller, and an arm's length transaction. If you've got multiple backup offers, I don't care that XYZ 123 Street sold for $950,000 3 months ago. You've got 9 people willing to pay $1 million for this asset today. That's market value.
Yeah.
Does that make sense?
Yeah. So you can sense where you're coming. I can sense where you're coming from. Of like, if the market is rising, it's kind of like coming back to the pandemic time where I remember a bunch of our friends and family like trying to get into the market, and we're just seeing like, all right, the market is growing so rapidly. Like we need to understand where we're at in the cycle and understand that like how much we need to meet the market as well, and why is it worth meeting the market based on where we're at in the property cycle too, because it's so like, all right, cool. I remember you saying like to my cousin looking for a home, you just need to pay a little bit more to meet the market, and they were like, well, it's insane price, but understanding where they were at in the cycle, they crushed it. Like just by holding it for a couple of years, and that's very empowering for somebody that is thinking, oh, am I overpaying? But if you know where you're at in the cycle, you can have more comfort in like bidding in a way that can you can have a bit more confidence in how the market's going to move.
Yeah, it's just education and knowledge, right? Like it definitely helps. It reduces that risk, and it sounds like it's a pushy person to go, put more money on the table. But I've been through it multiple times. I've seen multiple eyes, even clients that I'm working with now, where we put really quality assets in front of them. My analysis is, my target's to be within 2% of the purchase price every single time. My average is I'm about 0.4% below what they actually go for now over the last 6 months, which is
awesome. Congrats.
I'm super proud about that. It's very difficult.
Yeah.
But even with all that information, and I can openly share all these analysis that I do for people, but it's just like I put $550,000 on a property, and people come back and they're like, "Oh, I'm not willing to pay any more than $475." It's like, well, you're wasting everyone's time. Like, no one's going to sell that asset, and if you only wanted to pay $475 for that asset, then you're going to have to be in a different market. And with that mentality of always wanting a bargain is going to get you further and further away from just putting your money into a good quality asset that's going to grow in value. And another point too is, if someone's willing to sell something for 10% below market value or more, you got to ask yourself,
why?
Is this even a good quality asset?
Yeah, why are they willing to sell it for less than where the market's at? Like, It's such a good point you mentioned. Like, if you're always trying to find a bargain, I don't know. I don't think that's the best way to build wealth, or to grow, is just try and find and always buy something cheap. I think it's better to buy, quality, and pay for it. It comes back to the Warren Buffett saying of like, it's better to buy a good property. He says business, but it's better to buy a good property at a fair price than a fair property at a good price.
Yeah, I'll start to use that little quote that you've said in a few conversations with people. But I'm pretty chilled with the whole thing. It's your money, your choice. I'll give you my opinion, and then time will prove whether I'm right or wrong. And uh, I mean, it's proven itself in the past couple of years. But it's a journey, and people, they might take longer to transact than others, and that's fine.
Mm,
It's your money, as I said, it's your comfort levels, and it is millions of dollars most of the time, hundreds of thousands for those investor clients, and uh, I get it. It's highly emotional, and it's difficult. So there's generally an education period, and I guess that's a big part of obviously what we're trying to do is educate people to a point where they can understand what they're getting involved in, because it's not simple. You go see your bank or your mortgage broker, get a purchasing capacity, and then just go and buy any old asset, because you could be buying an asset that is that bargain price, but the risk on that is if you had to sell that property and the market had turned and it's in a downturn period, this is where property bites you in the butt, and they are just you've got an asset that is not attractive to the vast majority of the buyers in that market. You can't sell it. If you have to sell it and no one wants to buy it, you're going to be consistently just dropping your price and dropping your price to a point where you might even default on your loans, and then you're going to get a bad credit rating, and then the bank's going to repossess that property. That's when you start getting into financial hardship, and that's what I don't want people to do. So
mm.
the best way to do that is to buy the right asset in the right location at the right time, and just let time do the heavy lifting, and you'll be thankful for it when you've got that good quality asset in any market.
Yeah. Let time do the heavy lifting, and also the people that understand how to find the right property in the right location at the right time. Give the heavy lifting to them, and then give it up to time, and you just putting. This is where I like to say you're putting time on your side, not against you, and that is a real mind bender for people, because they feel like they need to rush to wealth or rush to a certain thing, when hey, you can actually, time doesn't always need to be against you. So
Yeah, I'm learning a lot about that. Like, we're so fixated on time, right?
yeah,
But I mean, time's just a construct of humans putting it, like 9 o'clock, 8 o'clock. It's just like
yeah,
you wake up with the sun and go to bed when you're tired.
yeah.
Let your body be your clock. That's what I'm trying to learn at the moment, and I'm just always looking at time. But I guess I've just been brought up in that, you know, be here at this time and do this
We
thing.
all
And
have though, like, I think where time really stuffs people up is like expectations of certain things happening within a certain time frame, like trying to achieve a goal. This is where I talk a lot about mindset stuff with my clients of like, if you see a case study of, and we'll bring some of our friends and family on, of like people that have bought properties and what they've achieved and stuff like that. But like, if you see a case study that somebody has achieved a certain result in a certain period of time, and then you go away and set that expectation for yourself, you're setting yourself up to fail, depending on where you're at financially, depending on how many resources you can put into it. Like, it's not always going to be the same. And typically, I don't like to tell people to measure time. I like to tell people to measure inputs. So for somebody to achieve a certain thing, they need to do a certain amount of work, right? It's not like they need to wait a certain amount of time and it will just happen. So some people that might take that certain amount of work, it might take them a year to do. Sometimes it might take people 4 years to do that same amount of work, and they achieve that result. So we shouldn't be comparing time when, yeah, and then also when we set that expectation of like, I need to achieve this within a certain period of time, it restricts us, because then we put stress and pressure on ourselves of trying to achieve it in that certain time frame, and we don't perform the best most oftenly when we've got too much pressure and too much stress. sometimes a little bit can light a fire up our bum and can be healthy, but too much of it is and then you can swap it. Like if you don't give yourself this crazy expectation and you take time away from like you trying to achieve it in a certain period of time and you just give yourself more time, typically we can perform better.
Yeah, yeah. And another thing is, what I'm learning anyway, is there's different facets of life. It's not just financial. It's looking after the vessel that you're in. You've only got one of them, being your body, and then hanging out with your kids or hanging out with your mates. Go for a bushwalk. Get involved in nature, and then you invest. Obviously, we all need to invest to create that financial independence, and that can be in businesses, creating your own, buying a business, investing in a property, buying a principal place of residence and renovating it to a point where you can manufacture that equity. There's so many different vehicles, but it's what lights you up and what you enjoy doing is important. Looking at the big picture, not just one facet. And as you said, not rushing the outcome, because you don't know. Think about where do you think you're going to be 5 years ago, and where are you today? And are you any happier? Any sadder? Like for me, it's I'm super content with life. I didn't think I'd be here 5 years ago. Put it that way.
Yeah, very different. You have a very different lifestyle than 5 years ago, which is so cool.
So you, mate, you're living in Bali
Yep.
now. You're an expat.
Expat, semi-retired expat. Very different than 5 years ago of working my tits off. All right, well, let's wrap that one up then. That's a great pod. Thanks, Sam, for the chat. And reach out, guys, when you need help.
Yeah, hello at propertypowers.au. And don't forget to check out the free resources on the website. So propertypowers.au/resources. And enjoy the journey. Any questions, reach out. And thanks for listening.
Cheers, guys.